I'm Kim Woodcock, a Communications and Events Officer at CEE. So just a bit of housekeeping before we get started. The call will be recorded, so if hopefully everybody's okay with that. If you're not happy to be on camera, please turn off your camera. The recording will be uploaded to our YouTube channel and Lemio. Also on the call today, we have Philip. Philip, would you just like to introduce yourself?
Hi everyone, yes, I'm Philip Coventry, Head of Operations at Community Energy England, here to support Kim today.
Okay, so if you've got any questions for any of the speakers, please just pop them in the chat. We'll be monitoring this throughout the call, and then we'll ask some questions at the end once everybody has done their presentations. So, 1 second. Not moving on. That's a good start, isn't it? Let me stop sharing and go in. Okay, the slides aren't moving for me, Philip. Would you be able to present for me? Share the screen. They're not, just not moving. This is a good start.
Kim, I am afraid I'm ignorant about how to do that from Google.
Okay. You go share your screen at the bottom.
Yeah. Do I need to have the thing in presentation to start with?
Yeah, just then share your window.
I can't see anything else if I do that. Kim, I would say carry on, and I will try and sort this out while you're doing it.
Okay. So, for those of you that haven't never joined us for a monthly members call, they are 1 hour monthly member space just from our members, usually held on the last Tuesday of each month, and we have a focus for each call. So the calls allow you to connect with each other and the national network. It's also a place for you to feedback to us on our priorities and help us and the network grow together. Just a reminder of the call topic today. So we are here to set best practice for the coming year with top tips on setting up community business and some key governance and finance management insights. The agenda for today's call is we're going to do a bit of a welcome in terms of from CEE and what we're all about. And then we'll give you an introduction to Lemio. And then we've got 3 speakers today joining us. So we've got Mike Ford and Peter Parker from Wrigleys Solicitors, Claire Humphreys from Naturesave Insurance, and then Gill Fenna from Quantum Consultants, who is also Director of Morecambe Bay Community Renewables. So following our speakers, we will have time for an interactive Q&A session. And then we'll also close with just a bit of a reminder of the CEE resources available to you. So just a quick introduction to CEE. Community Energy England was founded in 2014 by practitioners within the community energy sector to act as a voice of the sector and help put people at the heart of the energy system. So our membership has grown to over 300 community energy organisations and a range of other stakeholder organisations too. All our work is intended to help clear obstacles, create connections between practitioners and stakeholders, and facilitate the work of community energy organisations, thereby benefiting the whole sector. We also work to make politicians, national and local government officials and national network operators aware of community energy benefits, needs, opportunities and policy obstacles. This is to ensure that community energy organisations can create new projects and play an active and important role in the energy transition. So if you do want to find out more about government policy work and activities, please take a look at our policy and advocacy section on our website. And you can also see our current consultations, our active campaigns, and our policy responses, as well as find guidance and resources on how you can play your part. In terms of Lumio, how are we getting on with the slides, Philip? Are they up or? Oh yeah, there, brilliant. So Lumio is our online practitioner forum for our community group members. So if you are from a community group, you will have received an invitation to join the forum as part of signing up to this call. We would encourage all community members to become members of this forum. The forum encourages you to move beyond emails and connect directly with the sector, ask questions, and work through issues and challenges together with our network. So, and it is also a really good opportunity to offer assistance, share experiences and talk like openly with each other and share documents, videos and other resources as well. So this platform also helps you to become and feel part of the community. So yeah, please do accept the invitation. And yeah, if you haven't already, please join. Right, so now it's time to hand over to our first speaker, Mike and Peter from Wrigleys Solicitors. Mike and Peter will be sharing advice and top tips for those considering setting up their organisation as a legal entity. So each speaker today will have 6 to 8 minutes, and we ask speakers to just try and keep to time, please. If you have any questions for Mike or Peter, please pop them in the chat, and we'll be doing a Q&A after all the 3 speakers have presented. So Mike and Peter, I will hand over to you, and if you just let us know when you want the slides to move on, we'll do that for you. Okay.
Great. Thank you, Kim. Can I just check you can all hear me?
Yeah.
Brilliant, thank you. Okay, so afternoon, everyone. Thanks especially to CEE for having us along to speak to you today. As Kim has said, I'm Mike Ford, I'm a solicitor, and I'm joined today by Peter Parker, who's a partner, and he'll be assisting me with the Q&A section. We are both part of the Charity and Social Economy team here at Wrigleys. We advise charities, social enterprises, and community bodies on a wide range of matters, including in relation to community renewable energy. We see our offering as mainly being threefold. So we advise on governance, on property, and on finance. And in line with today's topic, as Kim has just mentioned, we thought it'd be helpful for us to give you a very, very brief overview of the different structural options for incorporated bodies through which you can run your projects. This will be quite a whistle-stop tour given the time, so apologies if you think we're going a bit quickly, but we can pick up anything in the Q&A section at the end. So it's important for you to put in place a formal incorporated structure for a number of reasons, including being able to contract in the organisation's own name and to limit the liability of members or owners. Thank you, Philip. But it's also important to consider what the organisation will be doing and how you're going to fund the project when you're making this decision or when looking to convert. We're going to stick largely with this slide now for the remainder of the presentation, but I'll let you know when we want to move on. So we're going to start briefly with the Companies Act companies, which are the company limited by shares or a CLS, and the company limited by guarantee or a CLG. But we are going to effectively ignore the company limited by shares, as this is the primary for-profit structure in this country, and that makes it very difficult to obtain grant or community funding or to show any constitutional protection for your defined community. A CLG, on the other hand, is slightly better. So it's run by a board of directors and has members rather than shareholders. They usually operate by way of the one member, one vote regime, but it is possible for the Articles of Association particular members have voting rights because there's no share dividend payable. But we'd expect the articles of the CLG to include quite robust provision and protection about the objects of the company, the purpose, its use of funds and profit in order to be able to attract such funding. This isn't a perfect solution, however, as the Articles of Association can be changed at any point by a special resolution, which is a vote of at least 75% of the members. So if we move along in terms of the rows, we can look at the community interest companies, or KICs. These are one of two types. They'll either be limited by shares or limited by guarantee. KICs require the approval and consent of the KIC regulator on incorporation or conversion, and they're structured largely the same as the Companies Act companies, but there are two key differences. The first is that a KIC must have a community interest statement, which sets out clearly the identity of the defined community which it intends to serve. This is a group of people or a specified geographic area. And the KIC itself then operates for the benefit of that defined community and not for the benefit of its shareholders or for the organisation itself. The second and most important one is that all KICs have what's known as an asset lock. The asset lock is statutory in its nature, and once a KIC is incorporated and registered, the asset lock applies to all of the KIC's assets and it can't be removed. The purpose of the asset lock is to cover all the assets of the KIC and ensure that they must be utilised for the benefit of the defined community. If a KIC is limited by shares rather than by guarantee, it will suffer the same issues as the CLS, in that it's viewed as a for-profit entity. The asset lock does prevent payment of dividends on shares over a particular threshold of its distributed profits. At the current time, this is 35%. And the balance of any profit must be used for reinvestment in the community, but this is still viewed as cash usage for profit, so makes grant funding more difficult. Where assets that are held by a KIC are intended to be transferred or sold, there are restrictions on how this can be done and to whom. It must be for the benefit of the defined community, for full market value, or to another asset locked body. That is another body with an asset lock in its constitution. Any sale proceeds from such a sale would become subject to the asset lock as soon as they're received by the KIC. Financing options for a KIC are wider than for Companies Act companies, as the asset lock does provide a greater level of protection. As mentioned, as a KIC with shares can still make payments out of some of their profits, grant and charitable funding is more likely to be available to a KIC that's limited by guarantee. The next option we have is the Community Benefit Society, or a CBS. And this is a particularly popular choice of legal form for community energy bodies. The CBS has a board of directors and a wider membership, and it operates for the benefit of its defined community, which is important to note doesn't mean its members. It's governed by a set of rules which operate in the same way as a company's Articles of Association, and those rules will specify what the defined community is that the CBS serves. They're registered with the FCA on the Mutuals Register. CBS's members are actually shareholders, but they operate under the one member, one vote rule. So it doesn't matter how many shares a particular member holds, you'll only ever have one vote. And the CBS doesn't pay dividends on their shares like a company limited by shares or a KIC limited by shares does. Instead, they pay interest. But this is subject to strict rules about the level of interest that can be paid and the time periods. On incorporation of a CBS, or later in life, if desired, a CBS can implement an asset lock similar to a KIC. They do that by putting it into the rules, and this will thereby prevent the sale or distribution of assets other than for the benefit of its defined community. The difference between a CBS and a KIC is that a CBS elects to have the asset lock, it doesn't have to have one. However, it's very important to note that once an asset lock is implemented for a KIC's rules, it's then permanent. You can't take it out again. CBSs can access loan funding and grant funding, and it's not usually much easier to access grant funding where the CBS does have an asset lock for the reasons we've touched on already. But it can also raise funds through community bond or share offers, and this is what makes it the most popular choice for community energy organisations. A CBS is exempt from certain of the normal statutory requirements when making these kind of community bond and share offers, subject to certain conditions, and it's these Statutory requirements usually make it prohibitively expensive for other organisations to do this. In particular, the issuance of an FCA-approved prospectus is very time-consuming and very expensive, but a CBS doesn't have to deal with that. Moving on from CBS, we have the cooperative or co-op. A co-op is the second form of society available, with the CBS being the first form of society. It has a board of directors and a wider membership, and it operates for the benefit of its members rather than the benefit of the community, which is what the CBS operates for. As with the CBS, they do operate under the principle of one member, one vote. They are registered with the FCA on the Mutuals Register, and as you can see from the table, have many of the same advantages of a CBS. Co-ops were once a very popular vehicle for community energy groups, but in recent years we've had some issues with the FCA about this. New registrations have therefore become more difficult. This is because a co-op has to trade with its members. And the way in which the national grid is set up in this country makes it difficult to prove that the energy that's been generated by that co-op are actually going to that co-op's members, unless you have put in place a system whereby the energy goes directly to the members as in a direct feed, but that's, as you can imagine, highly unusual. Therefore, the FCA has actually been adopting the approach that energy co-ops are investment vehicles rather than cooperative societies, which is against the regulations. We have recently seen some progress in this area, but caution does still need to be advised. And finally, the final column there is the CIO, which is a charitable incorporated organisation. It's a relatively new structure, just over 10 years old, and is distinct and charitable. It's only registered at the Charity Commission and doesn't come into being or effect or existence until it actually appears on the Charity Commission register. It's structured largely the same as a CLG, with members and board of trustees rather than directors. But they may be called directors, they are still charitable trustees. And there are additional requirements on the trustees that directors of the other types of structure won't have to consider. The key difference for a CIO is that the CIO's actions and the use of its assets must always be carried out with the intent to further its charitable objects and purpose. But it is unusual, therefore, for a CIO to be the preferred vehicle for renewable energy projects, as a charitable organisation cannot partake in primary for-profit making activities, and the generation and sale of electricity would fall within that. So Philip, we can now move to the next slide. Awesome. Thank you. So this slide just shows you what the possible conversions are for each of the structures. If your structure is any of the left, you just move along and it shows you what you can and cannot convert to if you wish to. This may be of interest to those of you who already have your legal structure set up and in place, but it's also very much worth keeping in mind when you're actually incorporating and setting up, looking forward to what your organisation is going to do, because some of the structures on the left are precluded from converting into some of the others due to the nature of their operation. So we're not going to run through the slide because we're at the end of our time, but as Kim said, this should be made available to you after the event. So we can move to our last slide, which just includes our contact details and information. So do get in touch if you want to discuss any of what we've rapidly covered today, or if you'd like to explore how we could assist. Thank you.
Thank you both. So our next speaker is Gill Fenna from Quantum. Gill will be talking to us through some governance and finance and how to get that right. So Gill, just over to you. Thank you.
Thank you very much. Yep, I am from Quantum, but I also have been involved in community energy for over 10 years as a director of Morecambe Bay Community Renewables and a director of Burneside Community Energy up in Cumbria. And I've been helping other community energy groups set up and get going over the years. So I'm going to talk a little bit about governance and finance, which is boring, but you do need to do it, I'm afraid. It's not nearly as exciting as getting a project off the ground. I'm just going to run through some of the things you need to think about. So next slide, please. Those of you that are already working in community energy will probably recognise this, but the typical business model for a community energy project is that you get a little bit of seed funding or grants or pioneer shares to kick off your project. You spend a lot of time developing a fabulous project, and then you go out and raise some money usually through borrowing, often through community shares. You spend that money on your project, and then you use the income to pay back what you've borrowed, put money into your business to pay all your expenses, and then have some left over to pay out community benefit. And this typically is the community benefit society business model that you've just heard about. But around that, there's a lot of other stuff that you need to do. So next slide, please. Because as an organisation, you have a lot of people that you and other organisations that you need to deal with, respond to, and you've got some rules and regulations that you are governed by. So you've got all of these other things going on that you as an organisation and people in your organisation really need to know about and understand. And I'm just going to cover some of these, but not quite all of them. Next slide, please. So the first and probably most important one is your governing document. As a community benefit society, that will be your rules. And in this, you need to think about and define what you're about. So what your organisation is wanting to achieve, who you are trying to provide some benefit to, and then use that to define what sort of organisation is most suitable. And we've just heard about that from Mike. Mostly I'm involved with community benefit societies. So part of this is about who the beneficiaries will be. In Lancaster, our beneficiary area was set up to be deliberately vague, calling it the Morecambe Bay area, so that we didn't just have to provide benefit to people in Lancaster. But we've set in our rules how much of our surplus is going to be spent on community benefit and the sort of organisations that or projects that we can support and the ones that we can't. So it's quite a bit of thinking early on about what you want to be doing. You also need to think about who you're going to be regulated by. Again, Mike's touched on that. Most CBSs are, or all the CBSs are regulated, have to report to the FCA, but aren't as strictly regulated as other organisations. But you need to know what sort of reporting they require and who's going to do it. You need to know what you are allowed to do and what you're not allowed to do. Again, this is referring back to what Mike's talked about. And your governing documents will say what you must do in quite a sort of admin heavy way. How many directors you need to have, when you have to have meetings, who can come to those meetings, when you have to have an AGM, who your membership can and can't be, how much money people can invest, what happens if you want to sell assets, what happens if you want to close down. So your rules can be 40 odd pages long, and it's really quite important if you've taken a standard set of CBS rules off the shelf that you do understand what's in them, and need to keep on top of it. Some of those rules can be changed, but some of them can't. So you sort of need to know at the start what you're setting yourself up for. Next slide, please. And then there are a whole heap of other contractual documents that you will end up with that affect how you can do your business, and really tell you what you can and should be doing. A lot of community energy organisations have invested in renewable energy equipment, and along with that, you will have some sort of lease of a land or roof space, and that will tell you things like when you are allowed to go onto that land, when you are allowed to access that roof, what processes you need to put in place to make sure that you are not in conflict with the landlord, what you have to do in terms of maintaining your equipment or putting the landlord in any form of risk, what the landlord can and can't do with your equipment. So all of that ends up defining some of your operational procedures. If you're buying equipment, you will have a contract with an installer. You will need some form of maintenance contract, and you'll also have a contract to sell your energy supply to your customers. Again, all of these have terms attached to them, and some of it is in the very long-winded detail that you really all need to understand. You particularly need to understand how they change over time. I'm just pulling out insurance as one thing here. Quite a lot of community businesses have had quite a lot of issues with insurance. Your insurance company might set limits on how much you could claim in the event of things going wrong. They might stop insuring certain types of equipment, such as small wind turbines. They might place conditions on it, such as how often you need to maintain the equipment and who is suitable to carry out that maintenance. We had a case where we had a lot of solar panels on the roof of a factory, and the insurance of the community energy company had to tie in with the insurance of the factory, all of which set conditions on the organisation, and all ends up being something that somebody within your organisation, usually one of the board, has to do something about. So you do need all to be aware of what those terms and conditions are. Next slide, please. And then the big one really is your business plan. And usually a community energy company will define a business plan as they set off, look at where your income's going to come from, what your costs are going to be, over what time you are looking at for your project. And alongside that, you will have a whole heap of assumptions and scenarios within it that say, well, what happens if, what happens if inflation goes up to 10%? What happens if there's a pandemic? Yeah, most of us didn't foresee that one. And that business plan needs to be fit for purpose for the people you are going out to get funding from. So again, those people might have conditions related to your business plan that you need to incorporate. Usually it's I was going to say simple spreadsheet. Usually it's a spreadsheet. Often it's not very simple, but it's something that you need to keep on top of as a live document. And then normally you would end up using that for managing your business and reporting against the things in your business plan to sort of make sure you're keeping up to date. And finally, next slide. Finally, I think it's important that you have a risk register because there are quite a lot of risks associated with community energy. And again, understanding what those risks are at the start is quite an important process to go through. And the risks can be everything from things that might affect whether you're getting any income or not, what might happen in terms of your operating costs, what might go up or down over time, what's going on around the outside world that might affect how you operate and actually whether you can continue to make money like you thought you were going to do. But also some important stuff around your internal capacity. And this is where quite a lot of community energy businesses start to struggle after a period of time. Often if you're run by volunteers, you run out of people's ability to provide the time and energy. So I can send around an example of a risk register, but I haven't got time to include it today. I'll just finally like to move on to the last slide, which is, I haven't really got time to cover this, but a lot of community energy is all about the people. And again, it's another thing that really affects your business plan, your governance, and how well you manage to continue with the organisation. I think that's for another time. So thank you very much.
Thank you, Jill. Thank you. So our next and final speaker is Claire Humphreys. So Claire is going to share her own slide. So if you can just stop sharing for a while, Philip, and we'll hand over to Claire.
So can everyone see my screen now? Yeah. Cool. Okay. Great. So for everyone that doesn't know or met me before, my name's Claire Humphreys. I'm Director of Naturesave. For people that don't know who Naturesave are, we are an ethical broker based in Totnes. We were founded back in 1993, so we were going for nearly 30 years. Matt Criddle, who's the founder, set up Naturesave essentially to be the body shop of insurance. So he was a broker in London, was a bit disillusioned by that whole industry and wanted to set up an ethical insurance broker. It's difficult to define what ethical is. It's very different for different people. But the idea is that essentially we create a movement to stop insurers insuring new fossil fuels. And we try and pick insurers that aren't doing that going forward, which is difficult when no insurer is 100% perfect, but we try and work with insurers that are definitely working towards that goal and work with them very closely. So yeah, we're based in Totnes, and recently we were acquired by Lloyd & White, who are owned by Benefat Group. I'll just do a brief summary on who they are. Oh no, we're not going to do that. Yeah, Benefat Group are, their overall mission is to become the #1 corporate donor in the UK. So we are rated on a couple of different ethical platforms. This is more in relation to home insurance rather than renewable energy insurance, but I thought it was just worth mentioning that there are some engines out there that rate insurers based on different criteria, and we work with those insurers to try and move them up the tables. So the idea of today's talk about insurance is to try and summarise what you need to think about when you're setting up your renewable energy group and the insurances that you need to think about when you're doing that. Some of it depends on what kind of installation you're doing. I'm going to focus on a roof installation or a hydro site rather than a bigger ground-mounted solar farm that might include a lender. So the initial thing to think about is when you're choosing your system. One of the things that's coming in quite a lot at the moment is using new renewable energy technologies. Insurers tend to prefer systems that have been tried and tested already. So as an example, most insurers like to see it having run for 8,000 hours already. Has it been tried and tested? Has there been any breakdown issues? Rather than using an equipment that hasn't been tested yet, they tend to be a bit more comfortable if it's been tried and tested and has had a positive experience. When you're choosing your contractors or installers to install the equipment that you've chosen, it's also important that they have insurance to cover them as well, because if you had a contractor that worked on your site that didn't have any insurance, something went wrong in the build, which transpired later on, if they didn't have relevant insurance, then there wouldn't be any cover for that damage to your system or to the building that the system was on. So contract works insurance, that covers the build. I'm going to use solar panels as an example. When solar panels are put onto the roof, that covers them putting them on the roof for you. Employers and public liability covers their liability while they're on the site. And then if anyone's doing any design work for you, making sure that they've got professional indemnity to cover if that design work wasn't necessarily accurate. When you're picking the systems that you want to use, warranty arrangements are also really important, that you're getting parts and labour cover. I know that it's not going to cover for the whole length of the project, but once systems become out of warranty, then insurers feel that that's a higher risk for them. So excesses go up, premiums go up. It depends on the claims experiences you've had previously, but the longer you can get a warranty agreement, therefore, the better your insurance product. You know, the premium might be lower and the excesses might be lower as well. So it's worth discussing that with the manufacturer and the provider of those systems when you're choosing them. One of the main insurances to think about when you're starting initially, you might not have a project in line yet, or you're just getting going, is directors and officers insurance. So this covers wrongful acts that directors do, and I won't go through all the bullet points, but that kind of summarizes the kind of things that could happen, and it covers all the directors on the board. And when you're looking at the different types of renewable energy insurance, the two main ones that you need to think about are operational all risks insurance and public liability. So public liability would probably come first, because if you were putting some solar panels on a piece of land, you would gain ownership of that land before you put the panels on there. And there'll be probably a requirement in your lease to have public liability insurance. That covers any third-party bodily injury or damage that's happened on your site. The important thing to mention with public liability is that it's as a result of your negligence. So the damage has to be as a result of something you've done on that site, which then has damaged that third party or building. Once the site's operational, then operational all risks insurance is important. So that covers material damage, things like fire, theft, lightning, and then any income that you're losing whilst you're trying to get that site back up and running. What I've done, so you didn't have to hear me go through every different type of insurance there is. I've done a checklist of things to think about from your development stage through to construction and operation. And this is kind of like a checklist of things that through the time I've worked with renewable energy groups, things have come up as things to probably think about and tick off once you've done it. And it doesn't necessarily just cover insurance, it covers things that Jill's mentioned as well. And it's proved a useful document just to make sure you're covering all the areas that you need to think about. And that was it from me.
Thanks, Claire. All really useful stuff there. So thank you to all of our speakers today. We now have time to take some questions. So Philip has been monitoring the chat, so let's hand over to him and let's see what kind of questions have been coming up. I will spotlight all of the speakers so we can see all of their faces. Philip, have we got any questions coming through?
Actually, so start with some questions for Wrigleys, and then I'll move on to Claire. I can see that Jill has been active in the chat answering some already, which is great. So yeah, first for Wrigleys, please. There seems to be a bit of interest in the asset lock and learning a little bit more about that. In particular, the difference in, I guess, when you have an asset lock and when you don't, and particularly also in relation to conversion to a charitable CBS. So yeah, a little bit more on the asset lock, please, if that's okay from you too.
Thank you, Philip. So there was a good question raised, which is about what's the practical difference in a community benefit society having an asset lock if, as a matter of law, a community benefit society still needs to continually operate for the benefit of its community. I think the answer is largely to do with what the eyes of the stakeholders and what additional assurances does the asset lock give to potential stakeholders as to the fact that the assets of the CBS are protected for the benefit of its community. Because, for example, it would be possible to take a community benefit site that didn't have an asset lock and then convert that into a company limited by shares, which, as Mike explained, is not ideally suited for community renewables, because it one, doesn't have a protected community focus, and two, it has mechanisms of distributing, providing all of its distributable profits out to members. So for the eyes of stakeholders, the asset lock is sort of a really important mechanism, notwithstanding the fact that as a matter of law, a community benefit society, with or without one, still needs to act for the benefits of its community. So that's probably point number one. The second point is around, which I think is really to do with what practical problems may arise for groups that have adopted an asset lock within the rules of their community benefit society. And the point was made that it's not possible then to convert to being a charity if that's the route that the asset lock community benefit society wishes to take. And that's absolutely right. It's not possible to take that step easily because the statutory asset lock is actually incompatible with charitable status, because it effectively permits the transfer of assets to other legal forms that aren't themselves charitable. So that's not possible. I think this draws a separate point, which is some of the this is sort of more of an anecdotal thing really, which is the stresses and strains that some groups who are looking to incorporate often go over at the outset, and working out whether what form of structure they should take and how protected should it be, because they think they may need to change structure in the future. And to some extent, our advice is to try and take a structure that, at least initially, that sort of retains all bases for you really. And a good example of doing that is incorporating initially a community benefit society that is either non-charitable or doesn't have an asset lock. Then once you have a better idea as to the direction of travel of your society, whether charitable status is important, it's probably unlikely to be, but in the circumstances maybe, then you can adopt a statutory asset lock once you're more clearly defined about your routes of financing, your likely community, and your other stakeholders and how important they see that asset lock. So to some extent, when you're initially incorporating, it's a little bit about trying to reserve your position as far as possible if you're not absolutely determined, absolutely sure as to how defined the protection for your society should be. So hopefully that gives people a few steers around the nature of the asset lock.
Brilliant. Thank you very much. Thank you very much for the. Can you hear me? Thank you very much for the extra detail. Can you hear me?
Yeah.
Great, lovely. Thank you very much for the extra detail. I will move on to a really good question from Connie from Croydon Community Energy, which you've probably seen, but I'll say aloud for the benefit of those who haven't. So I think it's quite a good question from Connie, particularly because it captures the situation that a lot of groups who are starting up find themselves in, which is pretty overwhelmed with all of the regulatory and legal and financial kind of regulations and aspects that need to be kind of kept aware of and done particularly on a kind of regular or annual basis. So do you have any advice about how a group starting out, which might not have dedicated staff or, as Connie's pointed out, no specialist finance people in the organisation, for example, where to access something which will give an overview of how to run an organisation from the perspective of the legal side, I guess, is where your specialist area is.
Hi, I can.
Thank you, Jill.
pick that one up. Not entirely as she has listed. I think because we learned as we went along, we've never actually written down everything that we do. I think one thing that I might have that's useful is actually a job description for an admin person. Because in both of the community benefit societies I've been involved in, we realised we needed to pay somebody to do our admin because it was all getting too much for us. So I might be able to dig that out and share it, but I'll have to have a look for it. And I also have a sort of 3-page document that we developed, which was all the parts of a process of developing a community energy project. Again, which I'm happy to share, but it's not so much around the managing the organisation. It's more about managing the project. So if that's useful, I'm quite happy to share that as well.
Yeah, thank you very much, Jill. I can comment a little bit as well. I run the operations in Community Energy England, and whilst we're not the community energy organisation, we are from Wrigleys table. We're a company limited by guarantee, so we're slightly different. But we still have to deal with a lot of the regulatory and legal aspect and do our accounts and everything, which is all what I do. And so I can kind of, I hadn't thought about doing this in terms of sharing some of the internal resources that we have built over the years, but we have a governance calendar and a board cycle where we take things to committees that need to be reviewed. We understand we have the timetable for the annual accounts, and that ties into tax. We have accountants to do the tax, a bookkeeper and that kind of thing. So I guess, yeah, we've got to the stage of figuring out what we can do internally and what needs to be done externally by specialists who can keep on top of some of those things for us, which might be a step forward from where you are, Connie. But I guess part of building the organisation will be understanding what you can manage and what you can't, and yeah, making sure that people who specialise in things will be able to take care of it for you. But yeah, some of that stuff in terms of reviews, we've made a suite of policies to hopefully stay legal and compliant in terms of the HR and other operational stuff, GDPR, those kind of things. So yeah, we can think about sharing some of those as templates, for example. So it is complex, but I think, as Jill said, we built this up over time and put effort in over the years to trying to improve the internal policies and compliance of that nature. So it is a bit iterative as you keep refining things, realizing something's not quite good enough, making it better, that kind of thing.
John's raised his hand. John, do you have a related question?
Yes, please. I'm John Laker from Marlow Energy Group, and Co-op UK suggested very strongly that we have a risks register, which we didn't know how to actually impose or create. Gill Fenna very kindly mentioned that she had a risk register. We wondered if there's any chance of having a look at that rather than reinventing the wheel yet again.
Yeah, I've got a blank example, well, not blank, an example one I can share around with you, which is just a very basic spreadsheet. So I can send that out to go out with the documents about today as well.
Thank you, Jill. Yeah, we have one as well. So I could, mine has things in it, so I could take the content out of that and we can send that around as well. Because also with things like risk registers, I'm changing the slides by mistake. With things like risk registers, just to pick up on that question from Connie, there's an element of personal and organisational preference about how you exactly make the spreadsheet, what you want to have in it. You can have very detailed ones to cover the organisation as a whole. You can have one just for a particular project or service. And then you could have a higher level. So we have a strategic risk register that we use just for the board, which has only got 7 risks on it in order to keep it as focused and tight as possible on that board level view of the risks to the health and longevity of the organisation. If you're looking at the operational side, you might have many more risks that you want to keep track of. So again, there are some questions about how you use these kind of documents and who is looking at them. But yeah, that's something that we could, thank you for the suggestion, Connie, that's something that we could think about to have a more detailed session on a future date. Lovely, we've got a few more minutes. Let's have the insurance question. So Peter has mentioned or has asked why it is that roof-mounted PV panel insurance has become much more expensive recently. Assuming you agree that that's a trend.
No, I do agree. I think there are a number of reasons why insurance goes up, and it tends to be around claims experience. So if insurers are experiencing high level of claims, they tend to increase premiums across the board. Just to summarize the insurers that are actively in the renewable energy market, there are different scales of renewable energy. You've got, small, medium, large. I would put most of the groups that I deal with in the small to medium size. And there's about 5 different insurers that play in that field. So there aren't that many to go to. So as Jill mentioned earlier, there was a time when you could insure a small wind turbine. Now you can't, because there were lots of claims and a lot of insurers pulled out of that. So with solar roof mounted, we are seeing more claims than we ever have done. They tend to be a fire. When there was a lot of renewable energy installations, 7 to 10 years ago, they were installed very quickly, and we're now seeing the fallout of that because they might not have been ballasted properly and they're damaging roofs and falling off roofs and damaging third-party property. So that's one reason why premiums are going up. The other reason is that the market is very small. What I would say is that new insurers come in all the time. And when you have a new insurer that comes in, they tend to be quite aggressive and they pull those premiums down. Aviva are an insurer that is now coming into the smaller scale renewable energy quite heavily. And I've noticed that they're actually pushing premiums down. So I hope that answers your question in a roundabout way, but it kind of depends on the systems and the claims experience, but also the insurers that are willing to insure it.
Brilliant, thank you. See that so I'm just going to read it, and then Claire, you can take it hopefully in 2 minutes. So you say that D&O insurance should be in place early, but as a new and growing CBS, what information is relevant given that we don't know how we will grow yet?
So the directors and officers insurance is there to protect you as directors. So, I mean, do you mean that you don't know what you want to do as a group yet? Or
I'm sorry, Claire, it's Peter Carter from Energise Southdown. So we've got a number of prospective projects that we're looking for. We're starting to raise seed money. We haven't got anywhere in terms of actually developing a project yet. So we're in that growing phase. That's really what protection do we need as directors and officers at that early phase. And given that we don't know how big we are, what our income levels are, how many projects we'll have, etc.
I mean, I probably would say at your stage, it's around the advice that you're giving to your members. So it kind of, I would say at the point at which you're opening up share offers and offering advice to those members, it's when you need to think about, what situation could somebody turn around and say you didn't, you advised wrong and you were negligent in that advice, and, where you would need that protection.
But isn't it based on scale and sort of number activity?
Well, I mean, the premium's based on scale. So, the larger the turnover, the larger the premium. But you have a sort of up to figures. So I wouldn't say that at your stage you couldn't get it because you don't know what you're doing. I think that could change the bigger you grow or kind of the requirements that you need. But I'm more than happy to have a chat with you after this about what that looks like.
That would be really helpful.
Okay, no worries.
Yeah, that's a perfect note to end on, which is to kind of segue nicely into the fact that we will share the details of the speakers today, and obviously they are all have different capacities in terms of providing services, and each of them are different, but they are here partly because of their expertise, but also particularly in the case of Naturesave and Wrigleys, that they do provide services to the community energy sector and are available to provide advice and services to help with projects and organisations. So we will, share the details so that if you have further questions or you want to get an insurance quote or you need some legal assistance, we'll sort of send those details around so you can all access them if you wish. Just to clarify, Naturesave and Wrigleys are long-time members and supporters of Community Energy England. So just to note that in terms of their sort of long-standing support for the sector as service provider organisations. Lovely, thanks for all the questions. I will note them all down. If there were any that I didn't get to, I'm sorry, I'll run out of time for that section. So we will make sure any further questions get passed on to the speakers, and we'll try and get those answers out afterwards. And now I'll hand over to Kim for the final stage.
Thanks, Philip. So just before we go, can you go to the next slide, Philip, please? I just want to quickly make you aware of some of our resources that can support you and your organisation. So we have a national map of community energy projects and locations. We've had 60,000 views since its launch in July last year. If your projects aren't on the map, it's a great way to gain visibility and build your network. So there is a Get on the Map campaign, and more details on our website about that if you would like to get your projects up there. We also have a funding database with all kinds of information about our current funding available. Next slide, Philip. And there's just some useful links. Don't forget to submit your events so you can promote them on our website, and you can also share your jobs and other news with us in our member newsletters. So please do get in touch if you have anything to share. And finally, next slide, Philip. So just before we go, I just want to really quickly mention the Community Energy Fortnight. Community Energy Fortnight is taking its national, nationwide campaign, and it is a great opportunity to make your organisation's activities visible within the local community, but also show the rest of the sector and important stakeholders what community energy is all about. So this year's theme will focus on skill sharing within the sector to help us do even better than we already are. So it will run from the 10th to the 23rd of June, and we encourage you to take part in any way you can. Please take a look at our comms pack and other resources that we've got available on our website for more information and a bit of inspiration of how you can get involved. So just to sum up, basically, thank you everyone for your participation today and for joining us today, and thank you to all our speakers. And that concludes today's call. It was great to see you all. Thank you very much.
Thank you.
Viewing somebody else's.
Hi, Philip, are you still there? Yeah.